Hi, everybody. Philip from Stars and Stripes Financial Advisors here. Got a great question from my friend Kyle. Kyle asks, Phil, what's the tried and true principles behind discerning whether or not an investment is a good investment or not so good investment? Kyle, thank you so much for that question. If you have any questions that are related to finance that you'd like to hear me answer or give my opinion on, please drop them in the comments, send me a message. I'd be more than happy to address your questions. I'm a huge finance geek. Anybody that's known me for more than a day knows that. So moving on to Kyle's question, the first thing that I would look at is what's the investment or how has the investment performed in the past? So very reasonably, what's the average rate of return that it's experienced? What are the highs? What are the lows? So I have an understanding of what that volatility looks like. That's going to give me a sense of whether or not this fits into my risk tolerance. That's going to let me know what kind of rate of return I can expect. And by all means, past performance doesn't guarantee future performance, but it's a decent barometer to understand what you're getting into. Second thing that you want to look at is how expensive is it to invest in this investment opportunity? Just using some extreme examples here, hedge funds, if you're properly qualified, you may have to pay what's called a 2 and 20 fee. 2 and 20 fee basically means that they're going to charge you 2% off the top of the assets they manage, and any growth that you experience, they're going to charge you 20% of that as well. So that's very, very expensive. Not right for everybody. In fact, not right for most people. On the other end of the spectrum, you have very low cost ETFs, mutual funds, things like that. Some providers, Vanguard, Fidelity, that perhaps you're familiar with. Some of their funds are a fraction of a percentage point or even 0 percentage point. That they released some no-cost funds a year or two back. So those are really, really inexpensive. When I started investing, every trade that I made had a transaction fee of $7. Didn't matter if I was going in, going out, and it could actually go up if I placed a big enough trade or there was something special about it. So also be aware of what the transaction fees are. When you're talking about real estate, you've got to pay your brokers, right? There's fees associated with titles, deeds, all that sort of stuff. Just be aware of what it's going to cost you to make the investment getting in and to get out of the investment on the back end if that's what you're planning on doing. So that was the second point. Third point that you really want to consider, what are the tax consequences? Huge question, right? So if I'm investing in municipal bonds, massive tax breaks there, not going to affect my taxes. If I'm investing in a stock, perhaps when I sell it, I realize capital gains. That's going to be a tax. Every time I get paid a dividend, that's going to be taxed. So be aware of what the tax consequences are, what type of taxes are associated with it, and be smart about what's called tax location. So if I'm investing in a qualified retirement plan, I don't really have to worry about what those tax consequences are. I'm not going to pay capital gains. I'm not going to pay income tax on any dividends that I receive. But if I'm doing that in a taxable brokerage account, I am going to have to pay those taxes. Now there's pros and cons to each of those types of vehicles, but just be aware of what those tax consequences will be. So moving on to the fourth point that you really want to consider is, how does all this fit into your investment strategy in the first place? You really want to sit down before you start making investment decisions and say, what's my investment strategy? And have a statement written out. So a professional will make something called an investment policy statement. And that's going to list what your investment objectives are, what your time horizon is, what your risk tolerance is, the type, the rate of return that you're trying to target, what kind of volatility you're willing to deal with, and what type of asset allocation you want to have through time, right? All of these things, when written down, help you avoid that bias that you have as an individual, which will ultimately affect your total performance. There's been some research done that the average investor actually underperforms their investment vehicle by 2 percentage points. Excuse me, my cat has joined me today. So this is Basil making an appearance. But just keep in mind that we're human, we're going to be biased about certain things, and you really want to understand whether or not your investment really fits in your overall strategy. You want to have that strategy. So that's the fourth point. The fifth point that I want to talk about, which I think is very important, is where is this investment opportunity coming from in the first place? Who is presenting this investment opportunity? Is it a finance professional? Is it your electrician? I had an electrician pitch me on their most recent investment they made and how great it's been going and everything like that. Now, I can't trust an electrician with my financial investments. It just seems like a not so great idea. So just be aware when you're sitting around the dinner table and your cousin who has nothing to do with the financial markets starts telling you about this great investment that they've made. I'm sure they have your best interest at heart, but they probably just don't have the training or knowledge to have thought through all the consequences and how it may or may not be impactful for you and what it means for your personal situation. So if you're at the point where things are just, super crazy, you don't have the time to look into all this stuff, it's too much, you can't do all the research yourself, reach out to a financial professional. They'll help you make an investment policy statement. They'll look at your personal situation and help you figure it all out. So I'm lucky enough to be doing that. I love doing that. Feel free to reach out to me if you find yourself in that position. If you just want somebody to look over your shoulder and make sure that, you're on the straight and narrow and you're following the right azimuth, talk to me. Happy to help out. So, Kyle, I hope this answered your question. Please let me know if you've got another finance question that's on the top of your mind. That goes the same to anybody else who's watching this video. More than happy to field your questions, give you some insight, let you know kind of how I think about these things. So until next time, I hope you all have a wonderful week. And please, if you found this at all helpful, insightful, useful, like it, share it, follow me, subscribe depending on your platform. That lets the algorithms know, hey, this guy is actually putting something useful out here, and I'd like to see more of it. And then I can spread the good word a little bit further. So appreciate you all, and I hope you all have a wonderful week. Take care. Bye.